Welcome everyone to May's Market Insights. We are coming up on Memorial Day weekend. It was a beautiful, almost summer-like week until today when the weather has gone into the crapper and it looks like we're going to have rainy times for the whole weekend for at least those of you in the Washington, D.C., DMV area. But great to have you all with us and get a little work done. Pay attention to what's been going on in the world, the economy, the real estate market, get ourselves up to speed before hopefully everyone can take a little relaxation for the holiday. As always, I am your host, Paul Nalabondian. I am a local market expert, also a realtor licensed in Virginia, DC, and Maryland. And I also happen to be an attorney licensed in the District of Columbia, bringing you everything you need to know each month for the industry professionals, my fellow agents, lenders, if you're entitled, but then also if you are not in the industry, but thinking about buying a home, thinking about selling a home, or investing, we will give you everything you need to know. I am going to be joined by my colleague, Temi Koji. She is having some technical difficulties. Let me see if I can do a workaround. For Temi. Apologies for All right. Temi, if you are watching, I just set you a separate link to access. All right. It might just be me on here today manning the chat. Temi's having some issues accessing. Not really sure what that is. Hopefully we can get her. Okay. Temi is having some technical difficulties, so it looks like it is just going to be me on here today. So I will be keeping an eye out on the chat myself, and we'll try to keep up on all the comments. We'll not be doing as good of a job as Temi does, but let's go ahead and get rolling. So like I said, Paul Nalabondian, I'm your host here every month, realtor and attorney. And usually my colleague Temi is with me. And when I say colleague, she is a fellow agent with Fulcrum Residential. We are one of the top real estate teams in the country. And we are both proudly affiliated with Keller Williams Capital Properties, our lovely brokerage. All right, so we're going to follow the same format that we always do. We are going to go ahead and get started. Let me make this a little bit bigger so you can see that a little easier. Demi just still trying to get on. So, that's a bummer. It's always fun to have Temi's expertise and assistance on here today. Maybe she can get that worked out. All right. heading forward, just want to make sure everybody can hear me now. Should be able to. So we're going to follow the same format that we always do. We're going to start off looking at mortgage rates and economic data. We look at economic data because that is what impacts mortgages. We're going to follow mortgage rates specifically, go into the economy. Then we're going to talk again about the Iran war and implications. We're going to look at DMV, local economy, unemployment, what's been going on there. And then we're going to dive into real estate specific data. We're going to look at DMV data for the most recently reported month, which is April. Then we're going to take a look at the weekly data, see what's been going on in May so far, finish with some takeaways. As always, I love this to be as interactive as possible. There's an incredible wealth of information that can be provided by you all, either live or if you're watching this later on YouTube, watching the recorded version of this. You can chime in with the same thing. Would love to hear who is joining us, where you're at, if you are an agent, what area you practice in, if you're a consumer, if you're thinking about buying or selling, and where. And then also what you're seeing out there. Agents, love to hear if you're seeing multiple offers, if you're competing on your listings or with your buyers, that kind of thing, because that's what I'm experiencing. Very competitive market in a lot of areas, but I can't necessarily pull data on that beyond my personal experience and just people I talk to. So it's always great to have additional information there. All right, let's get rolling. So where are mortgage rates at? I can tell you what my clients have been getting. I can tell you what's being reported, but I would also like to hear what have your clients locked at recently, or if you're a consumer and got a loan recently, what have you locked at for your mortgage rate? Mark Linkowitz, if our lender partner is on here from Envoy Mortgage, if you could share what some of your clients have been locking at lately, that would be great to hear. And if you do plug that in, if you have any information on someone who has locked a mortgage rate recently, if you could let us know where that is. And also, kind of more importantly, excuse me, whether that's fee simple or condo, because condo mortgage rates tend to be a little bit higher. All right. So I'm going to pop on here. This was plug this on here. So this is like 2 days old. I think we were right around the same. Yeah, 667. So mortgages have popped up. They have been a little bit higher recently because of the Iran conflict. You can see that here. And then just to specifically highlight how this conflict in Iran has impacted mortgage rates, you can see the vertical line there is February 27th, the day before the initial air attacks occurred. And Mortgage News Daily was reporting 599, a little under 6. I mean, just a hair under 6, but still, it's great to see a mortgage rate with a number that stops with 5. Since then, it has been a pretty steep hike. And when you can see the peaks and valleys, the only reason for those valleys is when the expectation was that the conflict would be over relatively soon. And so honestly, that's the only thing even keeping mortgage rates right now in the 6.675 band. If the conflict is going to go on, or if things change and the expectation is it's going to continue for a while, we will see mortgage rates continue to increase. And scary as it sounds, that's almost sky's the limit, because that's just, I mean, choking off. It's already the largest oil disruption in modern history. So we are seeing rates pop up quite a bit. Most rates are up. 30-year is up 40 bips since we last met last month, and all products are up about 25 to 40 bips. Overall, as you could see in the last chart that I had, mortgage rates have increased about 0.75% since we met last month. So not great, but at least the fact with everything going on in the world that they are under 7 is still a relatively positive sign. Okay, now before we get into the economy, Temi provides many, many wonderful things here. One of the things she does is remind me to do the coffee of the day, which I always forget and belatedly remember. So we're just going to pop into this really quickly. The coffee of the day is a wonderful Rwandan coffee from the Shira washing station. This is brought to me by Ordinary Coffee Roasters in Germany by way of Airworks. Airworks is a Seattle-based coffee curator that helps source roasters from around the world, small kind of wonderful roasters. To order this directly from the German roaster would be a little cost prohibitive. So Airworks allows you to try a lot of wonderful coffee from incredible roasters around the world in a more economical, reasonable way. This is so delicious. Official tasting notes there: hibiscus, cherry, blueberry, floral. And I would have to say that's pretty spot on. It's a natural red bourbon, but very, very elegant and delicious. Okay. Hopefully other people like coffee on here and people didn't just fall asleep. Going back to where we are at here. How are people feeling about the economy? Oh, before we move on, just want to say thank you, Christina. 6.5 conventional loan. February 15th, 6.5 might not have been a rate that people were overly thrilled with. Right now, 6.5 is a pretty good rate. So good going for your clients, Christina. Okay, how are people feeling about the economy? I will tell you in just a minute. I've stopped going through this in a lot of detail. It's in the deck if you're interested, if you're just new this month or go back 3 or 4 months. I have the table of contents. You can go straight to the point of why I look at economic data. But in short, I look at economic data because that is what impacts the bond market. Mortgage-backed securities are part of the bond market. Most mortgages, conforming mortgages, are repackaged, sold as mortgage-backed securities where they have to compete with other products in the bond market. And then the bond market is competing with all other options for investors. Has to be a competitive product. When things are happening like inflation, bonds have a fixed rate of return. The higher inflation is, the less appealing a lower fixed rate of return is, which means that the return offered on those products has to be higher in order to get investors to invest in it, which means you have to have higher mortgage rates. So just in brief, when you're having inflation or problems like this that are affecting the bond market, you're going to be pushing up mortgage rates. And that's what we're seeing right now. Okay, jumping into GDP growth. So we had, last time we met, we had Q4 of 2025 release the final number. In the intervening time, we had Q1 of 2026 release, showed a very solid growth of 2%. These are only initial numbers. They're going to be revised. I expect there to be some changing, but 2% is a really solid GDP number there. And, Q1 ends in March, so you have a little bit of the impact from the conflict, and a fair portion of that is rising gas prices and oil prices. The United States is a net exporter of oil, and so while a lot of consumers are feeling the pinch of this conflict, you have a lot of American oil companies and manufacturers who are making a lot of money from these increased oil prices. So that is contributing to GDP growth as well. So I'm going to get to this, Maggie. I see your question. Would you say consumer confidence right now is being impacted more by mortgage rates themselves or the overall uncertainty? And that depends. That question really, it's a great question, but that depends on whether you're talking about real estate consumers or consumers in general. So I'll pop to that in just a minute when we talk about the Michigan surveys and the conference board. But right now, at least, like I said, first quarter looks like we had a pretty decent first quarter as far as all things considered. Now, Atlanta GDP model, Atlanta's lost their minds. Right now, they are predicting Q2 2026 GDP of 4%, which would be a ramp up. And like I said, it's just, because the U.S. is a net oil, net gas, net energy exporter now, things have changed a lot with the shale drilling boom and all of that. That higher oil prices, while not necessarily great for us, for consumers, they are benefiting a lot of countries and providing a nice little boost to U.S. GDP. So that's at the high end. You can see Atlanta Fed GDP Now model is always at the high end of what other blue chip estimates are. Those other blue chip estimates usually add a little color, add a little analysis to it, whereas Atlanta Now is pretty much, they just take in metrics and spit out a number. The New York Fed staff nowcast for Q2 is 2.6, and that tends to end up a little closer to what the final GDP number is. But still, any of those ranges are projecting pretty decent growth for Q2. Going to bump back in. This is a slide I've had now for a couple of months now, but just to reiterate, because the conflict is still going on, what does the conflict in Iran mean? And it means higher oil prices, which means higher gas prices, which increase the cost of not just gas, obviously, but any goods and services requiring transportation, and most goods and services require transportation, which leads to higher inflation. I told you this was going to happen months ago, and now it is happening. This means stress on the economy. This means higher mortgage rates. Talked about that was going to happen. Now it has happened. More stress on the economy leads to a higher recession risk. You're seeing that this is not expected. The models aren't predicting this because everybody thinks this conflict is going to end. But if it doesn't, the negative economic impact and the impact on the real estate market could be much, much greater. Talk about here, if this conflict is prolonged, it could lead to not only just the inflation we've already seen, but continued inflation and then a stagnation of economic growth. And it's really prolonged. Worst case impact is kind of a catastrophic to the global economy. Now, getting back to how are people feeling about the economy, still kind of record level bads, but it's interesting. And you'll see this in a lot of months. You'll see a little bit of a divergence between the University of Michigan Consumer Sentiment Survey and the Conference Board's Consumer Confidence Survey. So the last month we talked about Michigan survey was at a record low of consumer confidence, and it beat that record. So the final numbers came in a little bit higher than the early numbers we reported, but the initial May numbers were at 48.2, which is another record low. And this just reflects what a lot of us are feeling, that we're not feeling too confident about the economy. So record low consumer confidence in the economy. But then the Conference Board consumer confidence actually inched up a little in April. Now it's still low, so don't think people are thinking it's great, but it's actually been inching up a little in the past couple of months. And the reason for this difference is just really quick. The Michigan survey it keys in more on how people feel about the economy, what they're just feeling generally about the economy and where it's going. Whereas specifically the Conference Board's consumer confidence survey tracks in specifically about jobs and employment. And as we've talked about, the job market is weaker than it has been, but unemployment is still relatively low. A lot of people still have jobs. So that's kind of the reason for the disconnect. The Conference Board also has an expectations index, and you can see that is nearing the lowest levels we've seen in the past 10 years. So they're kind of saying the same thing, just in a little bit different ways. And you can see we're at 72.2. I know these numbers don't mean anything to anyone on here except for maybe Virginia Gergoff, our resident MBA in econ, but 72.2 below 80 is kind of a leading indicator for a recession, and we've been below 80 for a year now. So there are a lot of expectations, at least among the populace, that things are going to go downhill in a hurry. Hasn't quite happened yet. So now getting back to Maggie's question is about consumer confidence right now being impacted more by mortgage rates themselves or the overall uncertainty. So what I'm talking about with these surveys, this has more to do with the overall uncertainty of the economy, the fact that the jobs market, while not completely broken, is showing cracks. A lot of people are stuck in jobs they may not like, but there aren't other opportunities out there. And the people who are unemployed are staying unemployed for longer because I've said we're in this low fire range where employers are reluctant to lay off people, but they're also reluctant to hire people. So if you do happen to be employed, you're probably facing a very tough market out there. So that's the reason for the shaky consumer confidence overall, in addition to spiking inflation and people paying a lot more for gas, which we'll talk about when we get into inflation. But then when it comes to real estate, if you have a buyer who jumped into the market, and this is pretty typical. So I know I have clients like this. I'm sure a lot of you have clients like this for the agents on here. You have a buyer who's thinking, okay, I want to gear up. I want to buy a property this year. So they reach out, start talking to you about it in January, February, with the plans to ramp up when the market tends to be a little more active in the spring, and you're starting to run numbers and cost estimates based on a 6.1, 6.2 mortgage rate. And then all of a sudden, as you're heading into peak spring, mortgage rates are 6.75. And just ballpark, if you increase mortgage rates by 1%, approximately that'll increase your monthly housing costs, your monthly borrowing costs by 10%. So just simple math. This isn't the case for everybody. It depends on your down payment and a lot of other things. But if you have buyers who are running numbers in early February or mid-February about what they could purchase, how much their housing costs would be. Right now, those costs for them are about 7.5% higher. And for some people, buying a house is expensive. It's most people's most valuable asset. And a lot of times, buyers are stretched a little thin in the process. And when you increase those costs by 7.5%, it oftentimes does a few things. You can't buy the home you wanted to buy. So you have to get a smaller home, or maybe you were looking at row homes or detached homes, and now you can only afford a condo, or sometimes it prices you out of it entirely. So to your question, Maggie, I would say it's kind of all of the above for people who are looking to buy. Then yes, mortgage rates is definitely impacting their confidence in the economy, because it's just, the cost of everything is increasing, and it's specifically increasing the cost for what was probably going to be their biggest ever purchase. Okay, this is just, people like visuals. I like visuals. So here's a visual. You want to see, what does it look like when a consumer confidence survey is at an all-time low? Well, it looks like that. You can see it's a little impacted by the comment bar, but that kind of free fall diving part of the graph on the bottom right, which is at the lowest point you see on here, going back to 1960, or I think it's been going for 70 years. So I think the Michigan survey started maybe 56. Okay. Now we're going to take a deep dive into the local economy. Don't have the Bureau of Labor Statistics hasn't yet reported local GDP numbers, but we do have some employment numbers. And the employment numbers, anytime you look at local stuff that's being provided by the government, there's always going to be more of a lag than there is for the national numbers. But we're seeing some good signs, at least, and this is kind of to be expected in the region. Government layoffs have tapered off a little bit. That was really negatively impacting the employment picture in the area. So as you would expect, as the impact of that has steadied or tapered off, then you're going to see a little bit better employment situation here. DMV wide, overall DMV employment dropped to 5.2% in March. This is down from 5.7 in February. DC proper at 6.3. This has also come down a little bit from 6.7. Frederick, Gaithersburg, Bethesda, basically Montgomery County, you can see that unemployment in bulk Montgomery County is down to 4%, which is below the national average. So they have rebounded quite well. I covered a few months back that area kind of had the highest concentration of federal government employees who were let go or took the early retirement packages. So that really had an impact on employment in that area. The Northern Virginia employment is at 3.6%. Northern Virginia, throughout the recent history, has had the lowest unemployment in the area, but it's important to note that unemployment is rising dramatically. It was at 3% same time last year. Now it's up in the 3.6, 3.7 range. So overall, yes, the employment picture is better in Northern Virginia, but they have taken a serious hit in the past year, like everyone has. Just going to take another look at the comments. Thank you, Maggie. Yeah, and yeah, it's, Maggie's saying buyers may still want to purchase, but the affordability math has changed significantly in just a few months. It's changed dramatically. I mean, if your costs are 7.5% higher for a home and the budget was already a little tight, that would be problematic regardless. But when that's corresponded with a massive increase in gas prices, increased food cost, and it's also, this is just disproportionately, we'll talk about this in inflation, all disproportionately hitting lower income people, lower income families. Okay, now this is just graphs representing kind of the same thing. There's been some updated information. So this was from January to January. It showed the DMV metro area suffered the greatest job losses in all of the country as far as metro areas, more than 100,000 jobs lost from January to January. They have since updated the data. Now it's from March to March. And during that period, the DMV lost 108,000 jobs. And during that same period, 108,000, what does that mean? That means that employment in our region, in our immediate core metro area, shrunk by 3.2%. 3.2% of all jobs were lost over the past year from March to the prior March. As I said, the Bureau of Labor Statistics hasn't yet released the Q1 GDP, but as you can see, Q4, the entire DMV was much slower than the country as a whole. Instead of a positive GDP, we had huge decreases in DC and then also drops in Maryland and Virginia. Okay, now getting on to inflation, which is bad. So, month over month inflation was at 0.6%. So, on the positive, I know sometimes maybe I seem like I'm a little overly negative. There's just been a lot of negative stuff happening, but I want to mention positive things when they're here. So 0.6%, not as bad as last month's 0.9%, but it's still pretty damn bad because if you take away last month's 0.9%, this would be the worst monthly inflation number in 2.5 years. So because last month was even worse, it's not quite there. But the main reason for that was really the gas prices were shooting up dramatically in March, and they were increasing in April, but just not by quite as much. And you can see that when you do the breakdown. Increased energy costs accounted for more than 40% of the increase, and then increased shelter and food costs made up a good chunk of the rest. All right, now the 12 months. So this is 3.8%. You have one more month of a bump factored into the 12 months. Makes sense that even though the monthly increase wasn't as high, the annual 12-month all items number would be higher than last month. Last month was 3.3%. This month it's 3.8%. And don't forget, right before the Iran conflict started, our preceding months we were at 2.424. Just a hair, just a whisper away from the Federal Reserve's 2% benchmark. Now, of course, they also look at PCE and other metrics. They're not just looking at CPI, but still, when the CPI is getting close to 2, things are good. We could have seen more rate cuts on the horizon. Now that's not the case. And this is also annual inflation. This is the highest number in 2.5 years. And talked about, like, this is just building and building and building the longer this conflict goes on, because gas prices were immediate. So 2 months ago, that gas prices really spiked inflation because they were rising even more quickly than they were last month. But they're having a cumulative effect. The longer you have higher gas prices, the more that gets translated into all our other goods and services, because those become much more expensive and companies can't absorb those costs. They start to pass those on to the consumer. So the monthly inflation is still going to be bad, and this 12-month number could get a lot worse if the conflict goes on and continues to rise. And then also want to mention, like, this is just really, really difficult for people with lower incomes, because a higher percentage of your disposable income is spent on things like food, lodging, and gas. And all three of those things are becoming dramatically more expensive right now. Okay, before I'm going to come up with some other positive things to talk about when we get into the real estate market. The real estate market, there's actually a lot of good stuff going on, a lot of exciting stuff going on. But while we close out this CPI, just want to hit on again, in case anybody is new here, how accurate are these CPI numbers? Probably not super accurate, because we are having, we'll go into the whole different cell imputation, but there are these enumerators going out, checking on prices all over the country. They look at specific prices for specific things in specific areas. When they can't find that, they either take something from another area, make an adjustment, or they find something similar, make an adjustment. The Bureau of Labor Statistics does not have enough enumerators to do the job. They haven't had enough for quite a while. And so this number of guesses, which prior to about 12, 13 months ago was never greater than 10%. I never saw a month where different cell imputation was over 10% for a given month. Since March of last year, we have been in this band of 29 to 40% of the data that comprises the CPI has been guesses. Last month, we were at 40 again, which means, I'm overly simplifying this, but it's like almost half of the data that goes into the CPI is a guess. I mean, it's an educated guess. It's a very educated guess, but it's just not as, this data is not as valid as it once was. And then, I don't want to be overly skeptical, but when you have a lot of political pressure to put numbers in a certain way, and then you have the data comprising a number not based on actual data, what's happening there? Not sure. Okay, jobs report. Jobs report continues. You can see that we had some negative months reported recently. We had many months of really low job growth. We've rebounded a little the past 2 months. We had 115,000 jobs added last month, but it's the same thing I've been talking about. So out of this 115,000 number, about half of those jobs are in healthcare and social assistance. So healthcare, it's a defensive sector. Healthcare is always going to be vibrant. It doesn't matter how the economy is doing. And then social assistance, a sector dedicated to helping people in need. So this still is not painting the picture of us having a vibrant job market. I would say the job market is unchanged. We are still in a low hire, low fire market with a lot of employers just holding steady because they're not sure where things are going to go. The Iran conflict, on top of all of this, is just adding a tremendous amount of uncertainty to what was already uncertain times with the tariffs. A lot of businesses aren't exactly sure what their expenses are going to be, what their costs are going to be. And a lot of these decisions have to be made well in advance, and they have lasting impact. If you let a lot of people go and then it turns out things ramp up again and you need to rehire, that's a long and expensive process. So a lot of employers are just kind of holding off and waiting, which is why you're still seeing this relatively stable but much, much weaker job market. But if things go south, we could see this crack in a hurry. And I've said that one of the nicest things about a robust jobs market is it provides a buffer against recession. It provides a buffer against a greater downturn in the economy. Right now, we don't have that buffer. This jobs market is not robust. We do not have that buffer. So if things go south, they could go south in a hurry. And we could be talking about this like things are humming along. GDP is forecast to be this and that, and things look relatively solid. And then the next month we meet, it's possible that outlook could have changed dramatically. If the Iran conflict ends reasonably soon, I don't expect that to happen, but just saying it's possible. Okay, going on to unemployment rate unchanged at 4.3. Okay, what's going on with the Federal Reserve? Answer is not much, but it's become a little more interesting about where things are headed. They met right after my last market session, right after we met last month, April 28th, 29th. As expected, the rates were unchanged. Nobody expected any rate change. They're going to meet again in mid-June. One interesting thing to note is this will be the first meeting with incoming Chairman Warsh. He's being sworn in tomorrow, was already confirmed by the Senate, and it's likely that rates remain unchanged. Right now, the market expects no change in the rates at this meeting, and there's zero chance of a rate cut. Interesting thing is there's probably now a greater chance of a rate hike than a rate drop in 2026. And that's something to keep an eye on as we look at rising inflation if employment holds steady. So continue tracking about what's more important, kind of more meaningful, could be more meaningful in allowing us to have an independent Federal Reserve is Trump v. Cook. Said before, Supreme Court ruling, that's expected to be coming up in June. That'll be pretty momentous if they allow that to go forward. We could see a greater reshuffling of the Fed, more governors fired. If they don't allow Lisa Cook's kind of attempted termination to go through, then have a little bit more security, a little bit more independence in the Federal Reserve. And then the criminal investigation of Chairman Powell was dropped. That was ended, and which allowed the confirmation of Chairman Warsh. You had some senators saying they would not vote on that confirmation until the investigation against Chairman Powell had been dropped. So the net effect, like the only effect of all of this pressure being put on Chairman Powell by the administration in this criminal investigation is basically, instead of stepping down when his chairmanship ended, which is what chairmen typically do, what he was planning on doing, he said, no, I'm a little concerned about what's going on in the Federal Reserve. I'm worried about its independence. I feel like I need to stay in order to help maintain that independence. So he's staying on. It could be until the end of his term, which I think is 2 years from now. So that'll be interesting to watch. Okay. And this is just the percentage of probability the market expects whether there'll be a rate hike or a rate drop. Day before the first strikes in Iran, there was this model had a 40% chance of a rate cut at the April meeting, 5% chance of a rate hike. Obviously, a rate cut didn't happen at the April meeting. Today, they have a 285% chance of a cut, 614 chance of a hike. And this is just kind of holding steady because the expectations are the conflict will end. Like I said, if that doesn't happen, things could change in a hurry. All right, the 10-year Treasury is up a lot, up by more than 37 bips since we last met. And this is the highest 10-year Treasury in 16 months. And, when inflation rises and all this stuff, it's like the 10-year Treasury is a great place to park money at times of economic uncertainty. But if the times of economic uncertainty are surrounded by spiking inflation, nobody wants to be in a locked rate of return that could possibly be outstripped by inflation. If you have inflation that's higher than the rate of return on your investment, you're actually losing money by that. So this is the highest 10-year Treasury number in 16 months. And I just want to take a quick peek. Things have been so volatile lately. Just want to see right now where the 10-year treasury is loading up right now. Okay, 4615. So it's dropped in the last day. It's dropped a little bit. And you're seeing kind of a lot of volatility here because it's directly impacted with the conflict in Iran. And then also government debt. The more government debt there is, the more treasuries have to be sold. And usually you need to offer a little bit higher rate of return. Okay, I don't have a graph up here for the 30-year, but wanted to mention that also because it provides a little bit of a context in what's happening overall with the market. These government bonds, they're really important with mortgage rates because these are kind of competing with investors. 10-year treasuries are a safer investment than mortgage-backed securities. They can offer a lower rate of return, but there's usually a spread, and they usually track. And there's another product, 30-year treasury bond, which is also relevant. Just want to add, right now it's at 518, which is a 19-year high. The 30-year treasury is at the highest yield rate of return in 19 years. If anybody wants to do some quick math, 19 years was 2007. We've talked before about things happening for the first time, or last time something was happening was 2007, 2008, 2009. You never want that comparison. That's never a good thing. That was the global recession, global economic collapse, bad time. So anytime you're seeing something for the first time since then, not very good. Retail sales up 0.5% in April, down from the 1.6% increase in March, cooling off largely due to gas prices, which I mentioned. Gas prices were really spiking in March. They were increasing, but at a lower rate in April, and that pretty much directly affects the lower number there. Industrial manufacturing. So this is actually pretty positive. So industrial production rose 0.7 in April, manufacturing rose 0.6. And this wasn't just because of something related to increased oil prices or energy manufacturing. It was actually a fairly large range of sectors of durable goods all had increases in manufacturing and production, and it exceeded market expectations. So this is providing evidence of strength in the sector and meaningful business investment. And business investment is important because that's a good sign for the economy. Business investment usually leads to jobs and more wealth. Okay, now we are going into wasn't I actually missed Mark's comment. Wasn't looking forward to this slide. I see you're talking about didn't see when that came in, but that is funny. Great having you on here, Mark. And if you I didn't see it in the comments, but if you do have any clients who have locked lately, I'd love to hear what rates people are coming in at. Okay, now we're getting into real estate. How's the market? What are people seeing? I'm not going to beg. I'm just going to politely ask. I really, really do love hearing from the agents on here, either live or if you're watching later in a video, what you are seeing with your clients, with your listings. Are you having multiple offers? Is the listing sitting for a while? And if it's a listing sitting for a while and you don't want to say it's yours, you can say, I have a friend who has a listing that's been sitting for a while. And the more information, the better. If you could add what location, what price point, and whether it's condo or fee simple, that is super helpful. Also with buyers, you have buyers who have been submitting offers. What is the environment they have been encountering? Have they been able to be the only competition, the only entity get a house without competing, or have they been competing? I know there's a lot of competing going on in a lot of areas. And thank you, Mark. So mid sixes, 6.375 to 6.5, conventional 30-year. Yeah, and like he said, lots of volatility, lots of volatility. But those are good rates. If you're a buyer out there or you're an agent and your buyer can lock right now at 6.375, I would take that in a heartbeat. And it's possible. I mean, if this goes on, we could see sevens. We could easily see sevens. So thank you, Mark, for adding that. Okay, historical context. Most prognosticators, the Bright MLS, expected this to be a more vibrant real estate year in 2026 than we have had in the past years. Right now, that isn't happening. Right now, we are on track 49,052 transactions. That is the pace we are on. Just for context, we were at 49,408 2025, 49,942 in 2024, 48,950 in 2023. But it's still, I provide this information because it's important to have historical context. So we are in a greatly reduced market from where we have been, and that's just important to know. But and at the same time, if you are looking to buy a home in the DMV and you have 49,000 options this year, one of those should fit. If you're a seller looking to sell and you know that there are 49,000 buyers out there who will be purchasing a property this year, I mean, if you if you hire a good agent, do a decent job selling your home, you should be able to sell it. If you're an agent who puts food on the table, roof over your head from this business, and there are 49,000 transactions out there, that should be enough to put food on the table and put a roof over your head. So while this is lower historically, much lower than things have been, we're treading right around 2008 numbers. We already talked about, you never want to hear a comparison to 2008 because that means things aren't good. Yes, that is all true. And it's also true that this is more than enough for anyone with real estate needs to satisfy their goals. But it just means it's more important to understand then at a micro level what is going on and what's happening in the market. Take a look at the comments again. We have Christina saying clients are more price conscious than ever, but seeing multiple offer situations. Yeah, that's absolutely true. And like she says, maybe they're not escalating quite as high, a little more conservative, but still competitive situations with price escalations. And a lot of offers are under asking price or slightly above in Prince George's County. And that's also, if you look at the data, that makes sense because Prince George's County is one of the weaker markets as far as buyer demand relative to supply. And then Maggie chimes in. She has a listing that's been sitting for a while. I believe the main challenges are overpriced for the current market and high fees. So high fees, I'm assuming that's either a condo or an HOA. It'd be odd for an HOA fees to be so high that it would be cost prohibitive. So assume that's a condo. And yeah, I've said this last month, and it's true. Like the difference between the haves and have-nots is great. And by that, I just mean the homes that go under contract relatively quickly and the homes that sit. So if you are planning to list a property for a client, more important than ever that you price it appropriately, price it at market. And sometimes, like, in Maggie's case, I'm sure it's like we don't control our clients. We just offer information. They make the decision. And sometimes the decision is for a higher price that's not necessarily supported by the market. But those types of properties are sitting for a while sometimes. Speaking of how long things are sitting, all right, let's look at median sales price and days on market for the DMV. You can see here now we had a median sales price jump in April, a little bit of a jump, just 0.9%, a little over 1% year over year. But that is 35 straight months of monthly year over year price appreciation in the DMV, which means for almost 3 years, every single month, prices have been higher than they were for the prior month. And this is why I say, even with increasing mortgage rates, if you're a buyer, waiting is not necessarily the answer. It's the answer to pay more for a home if that's what you want to do. If you want to pay more for the same house than you could have paid today, then by all means wait. But there's not necessarily going to be a lot of economic benefit for waiting in this market because you have prices just rising and fairly dramatically in some areas. At the same time, there are two things you can count on pretty much every month. You can count on homes prices being higher overall, but you can also count on homes taking a little longer to sell. And when I dive deeper into the data, just my personal experience with clients out there, I think it's because, like I said, the difference between the haves and the have-nots is becoming greater. So the haves, the properties that are going under contract relatively quick, that are competing, they're pushing up the median sales price. And then the have-nots, the homes that are sitting for quite a while. And those are driving up the days on market, the time it takes for a property to go under contract. Interesting to note, though. So median days on market was 8 days. That's only up 1 day from the same time period last year. We were seeing larger jumps over the previous year before. And 8 days is not very long. That means that more than half of the homes in the DMV are going under contract in right around a week, which is incredibly fast. And that's also not a surprise because there's constrained inventory almost across the board outside of DC. Closed sales, new pendings. See, closed sales were up 2.9%. Not a surprise because pendings last month were up 5.3%. 2 months in a row of year over year increases in closed sales after being down 5 straight months. New pendings up big 9.3% in May. And this is really interesting because the first 2 weeks of May, pendings were down by about 5%. So middle of May, pendings were down 5% over the prior year. End of May, they were up over 9%. So we had a big swing at the end of May. Now, part of that is last year Easter was at the beginning of the month. This year, or this year Easter was at the beginning of the month. Last year Easter was at the end of the month. So there's part of a shift because of that. But that doesn't explain the whole thing. There was really a vibrant market going on in the last couple of weeks of April. Unfortunately, that hasn't really carried with us into May. The conflict is hanging over with mortgage rates increasing even more. That has tempered the market in my opinion. Still seeing a stable market, just not as robust as it has been. And you can see, though, that those numbers are right on track. Closed sales and new pendings right on track with about the lowest range of the past 5 years. Okay, new listings. After being down for a couple of months, new listings rebounded. They were up 7%. And in the chart here, you can see the orange line represents the new listings this month. That's the highest number of new listings for April in the last 3 years. So we are seeing more inventory, which is a positive sign. Active listings, same old, same old. We've now had more than 27 straight months of DMV wide increases in inventory year over year. The last time we didn't have higher inventory in a given month was January of 2024. And just want to mention it. So it's like, this isn't all the current administration and what they're doing. We were already seeing rising inventory for a variety of reasons in the DMV prior to the change in administration. Wow. Oh, wow. If that is 1,100 a month HOA, usually HOA fees are a little bit lower. So that's in Maggie mentions trying to guide the seller with the data, but difficult to get them comfortable with the price adjustment. And sometimes if you're selling a home out there, thinking about selling a home, or if you're an agent with a client and the price they want is not a price the market will support, sometimes you just have to wait for the market to tell you very strongly that that's not accurate. I mean, I totally get it. There's a lot of emotion involved. A lot of times people buy a home at a certain price, they put money into it, they expect the market to bring that price up to a certain level when it comes time to sell. And if the market hasn't done that, or if maybe when you factor in what they've put into the home and closing costs and that, if they're not going to net a return, that can be a little difficult. Okay, now we're going to break down. This is all the data. When you get the deck, you want to take a closer look, everything we've been talking about, going into county specific data. So as we discussed, we saw DMV wide, we saw price appreciation overall, not much though, but then there was pretty decent divergence here in the different areas. Big jump in Arlington, but that just looks like a distribution of property type. I looked under the hood and I saw that Arlington had a really big increase in home sales in the $2.5 to $5 million range, and then they had a big drop in home sales in the $300,000 to $500,000 range. And so you could say most of that bump in Arlington is simply due to the distribution of the type of sales. The prices are up 8% in Frederick and 4% in Fairfax, down a little bit close to even in Alexandria, Montgomery County, and Prince George's County, even in Loudoun, and then down big by 12% in DC. Interestingly, in DC, a lot of times when you see price declines, when you see prices going down in DC, you blame it on the condos. And a lot of months that's accurate, but not in April. Condo prices were actually up year over year in DC. Median sales price for condos in April was higher in 2026 than it was in 2025. The drop was driven by row homes and detached homes, but also important to note that this as well, like Arlington, seems to be driven more by a distribution of property types. In DC, $2.5 to $5 million sales were down by almost 55% in April, and lower price sales, particularly in the $500 to $600,000 range, were more than double what they were for the prior month. So don't take this as the sky is falling in DC. Property prices are dropping. I actually think apples to apples, prices are now holding steady in DC or even increasing. And a lot of us are seeing that in homes with multiple offers and, higher sales prices. Okay, closed sales. So closed sales up big in Alexandria, and that was across the board. Closed sales up 33% over April of last year in Alexandria, and closed sales were up for detached homes in Alexandria, up for townhomes, up for condos. Closed sales basically even in Fairfax, down almost 5% in Prince George's County, and up a little 2 to 5% everywhere else, which isn't shocking when you look at the pending data. when you look at the pending data for 1 month, it's pretty much telling you a rough range of where the closed data is going to be for the following month. Not exactly, but pretty close. Okay, now new pendings. We talked about new pendings up big for the region, and April was a strong month for buyer activity in all areas, all counties in the district of core DMV, especially in Northern Virginia, though. We saw Northern Virginia up by more than 10%, 16% in Alexandria, and then up big, a little more than 17% in Frederick. Robust, but in Prince George's County and DC too, which hasn't been the case lately. New pendings were up 6.3% in Prince George's, up by a little over 9% in DC. Not seeing that hold into May, but April was pretty strong. And then showing data here, you can see it's up in most areas. The most interesting thing I see in this chart is the fact that showings are down 4.4% in Alexandria last month, but pendings were up 16%. So that meant the buyers that were out in Alexandria in April were not messing around. Those were some serious buyers. New listings. So we saw some stagnation in new listings last month. Last month, only Frederick and Prince George's County had an increase in new listings. Month before that, only Frederick had an increase in new listings. You can see outside of DC, all areas in the DMV had year-over-year increases in new listings, and Frederick was pretty meaningful, 23%. Active listings. This we haven't been seeing as much, where we've seen some drops in active listings in some of the areas. So more of a mixed bag. Mixed bag. Inventory is down in Arlington, Loudoun, and DC, up a little in Fairfax, up 8% in Alexandria, then up big elsewhere, almost 13% in Montgomery County, 21% Frederick, almost 30% in Prince George's County. And just keep in mind, though, it's for these areas with increasing inventory, a 30% increase of nothing is still nothing. And I haven't updated this, but it's because it hasn't changed too much. I'll update it maybe every 3, 4, 6 months. But this is comparing inventory, active listings, March 2026 versus March 2019. I would say 2019 is the last normal year. And you can see that most areas still have lower inventory than they did in 2019. And here, as of March, DMV inventory was at 79% of 2019 levels. At the end of April, it was at 90%. So getting closer to 2019 levels, but still not there. And months of supply, this has been the case every month for almost as long as I can remember. Sometimes you'll see inventory spikes in Prince George's County, but other than that, per usual, outside of DC, you're not seeing meaningful inventory anywhere in core DMV. DC has 5.4 months of inventory, which by definition is essentially an equal market. Prince George's County is a little under 3. Everywhere else is near or under 2, which by definition is an extreme seller's market. So just by inventory relative to demand, you're still seeing strong sellers markets in most of the area. Going on to median days on market. So we've been seeing days on market increasing, kind of creeping up overall for a while now. Talked about 21 straight months of DMV-wide increases in median days on market. But similar to the overall number, these year-over-year numbers were a little bit more steady. And so you can see a lot of areas had no increase, no year-over-year increase for Northern Virginia and DC, up only 1 day in Montgomery County, up 5 days to 12 in Frederick. And then you have Prince George's County. They did have a big jump in days on market, up a week to 21 days. DC holding steady at 18 days on market. You can see here, it's most of the area. For most of the area, about half of the homes are going under contract in about a week. So relatively quickly. Now we are going to jump into the weekly data. And I'll be including the first 3 weeks reported in May so far. Take this first one, just, a little bit of grain of salt. It's not all May, and this week ended May 3rd, which obviously means that 4 of these days were in April. But you can see that new pendings were up 2.5% the first week. And I'll be popping back and forth between the slides. So apologies if there's a lag and it's harder to see. But new pendings were up 2.5% the first week. They were down 4.6 the second week, and then back up 2% the last week. So given what's been happening with mortgage rates, this isn't surprising. And I really see that determining how the rest of May plays out. If mortgage rates remain elevated in the 6.75 or get up into the 7 range, then we'll probably end the month with fewer pendings than we did last May. If rates drop or stabilize a little bit more, then we might see another bump in pendings. Going to new listings. So new listings were down the first week big, 7.4%, up 7.8% next week, and then up again this past week, 4.5%. So I expect we'll end May with a bump in new listings, continuing the recent trend. Showing level has softened a little bit. Median time to contract, you can see days on market here. It's in the 24 to 26 days, up seasonally as you would expect, and just not as much of an increase as the increase from the year before, which is what we've been seeing across. And I just want to know, I don't know the answer to this, but just for what it's worth, want to mention, if you see this and think there's a disconnect, or you're like, oh, wait, he says that these aren't really rising, but median days on market for April were 11 for the DMV, and now you're talking about in the 20s. Not sure exactly how Bright computes this weekly data, but whatever they're doing, it's not the same as median days on market. I mean, median time to contract sounds kind of like the same thing, but it's not the same as the median days on market that they report at the end of the month. Because when the May numbers come out, I can guarantee you it's going to be somewhere in the 8 to 10 range. It's not going to be this 24 to 26. So just keep that in mind. Still helpful, because whatever they're measuring is what they measured last year and what they measured the prior week. And so looking at the week over week and year over year change is relevant, but the overall number, that is not median days on market, that as far as what they report monthly. And like I said, I suspect at the end of May, we're going to see somewhere in 8 to 10. Active listings, as has also been the case lately, the one thing, if nothing else is consistent, usually there's a little more consistency in active listings. You can see active listings up each week, both week over week and year over year. Okay, this brings us to the key takeaways for this session. And so for the world, the Iran conflict is wreaking havoc with the economy, with gas prices, with mortgage rates, inflation, the economy, all this stuff, real estate market. Cheat code for this is follow oil prices. There are two benchmarks. Brent is for international oil, and there's another Beacon futures for U.S. oil. Keep an eye on those prices. If you don't want to follow the news, if it's too depressing, if you're not going to look at anything else, just add little widgets that track those two prices. And if those prices go up, inflation will continue to rise, mortgage rates will continue to rise. If those prices go down, we should see relief in both of those things. So real estate overall, then, the DMV market is holding up better than many expected. Even with mortgage rates, we're talking about near multi-year highs. Mortgage rates are near multi-year highs, still having the real estate market hold up fairly well. Still, more than half of all homes are going under contract in around a week. So still a very, very solid and reasonably vibrant real estate market, especially considering what is going on in the world, in the economy. And then agents, because of all this uncertainty, though, while overall the market is relatively steady, relatively solid, it really is a skill market. And that's kind of obvious from everything I've talked about today, which is, I guess, why this is a key takeaway, because almost everything I've said today relative to the real estate market and what's happening is it's really, you need to have hyper local expertise, pricing strategy, negotiation, understanding how these shifting economic risks impact things, because they matter more than ever. And things are very different depending on whether your buyer is looking in one area or another, or whether your seller is selling in one area or another. Buyers, still a pretty good time to buy. Still, put it on there twice at the beginning and the end, because it is still a relatively good time to buy. You can always refinance. And to be honest, any buyer I've had who's been under contract and closed a property in recent history had already planned to refinance at some point in the coming years when rates come down again, as we all expect they will eventually. And so if you can stomach the little bit higher price in the interim, eventually you'll refinance out of that regardless, and kind of be at the same point. But as we've talked about, prices still keep creeping up. And so if you wait, nobody's expecting a massive, meaningful drop in mortgage rates in the near term. I mean, hopefully we'll get into the sixes, maybe high fives sometime soon, but not like a meaningful drop below that anytime soon. So you're not going to see huge relief there, but you'll probably end up paying more for a home. And so that's why it's still, all things considered, pretty decent time to buy still. And then lastly, outside of DC, most of the core metro area is still an extreme seller's market. Not as extreme as it was before. If you had been thinking about buying a home for maybe 5 years or been in real estate, like, 8, 9 years, however long I have been in now, a lot of areas don't look like a seller's market because it's just not as extreme as how things once were, but still, by definition, a seller's market and still fairly competitive. All right. That is a wrap for today's official section. I'm happy to stay on for a little bit to answer questions in the chat. Want to have here my information. If you'd like to get on the list to get the deck each month, go ahead and shoot me an email there, or you can send me a text. If you have any other questions or comments, you can just drop them in the chat here. If you're watching this later on YouTube, you can throw it in the chat. I'll keep an eye on that and we'll respond. But also feel more than welcome to reach out to me directly. Yeah, Mark, our lender partner with Envoy Mortgage, mentions that buyers are still planning on refinancing. Most are looking at 2 to 3 years from now, though. It's the general expectation. And it's one of the things, though. It's not like if you're like, okay, I'm going to buy a home now, paying a higher mortgage rate than I thought I would, and then I'll refinance in 3 years. It's not like you have to lock yourself into that position. If you have all of my clients who have purchased recently, I keep an eye on things, as does Mark keeps an eye on things for his clients. And basically, that what we do is we keep an eye on rates. And then when we see, oh, rates have dropped by a sufficient amount to where it makes sense for someone to think about refinancing, then we let them know, we give them a little reminder. And so the nice thing is, it's not something, like I said, has to get locked in. It's like if rates drop all of a sudden, you can just make the decision right then to refinance. So very flexible in that time frame. But I would agree with you there, Mark. It's all expectations are, it's probably not going to make sense to refi before 2 years. Thank you, Maggie. I appreciate that, and also appreciate all of your comments and input there. If no one has any other questions, don't see any on the various platforms, we are going to go ahead and call it a wrap. I hope everybody has a wonderful holiday weekend. If you're around here, make sure, for those of us Fulcrum peeps, we all have our Fulcrum rain jackets, which will probably get heavy use this weekend. Hoping the weather turns. Really wanted to get outside a bit. But yeah, just hopefully everybody can get some relaxation. Or for my colleagues who are just hard charging agents, hopefully you can get some clients under contract, get some of your listings under contract. And yeah, so thanks all. Thank you, Mark, for the contributions. Very much appreciated. Really enjoy doing this each month and having the dialogue and the back and forth and getting that boots on the ground, additional information and detail from you all. So take care. Happy Memorial Day weekend. We will see you next month, same time, same place in the virtual world on YouTube, Facebook, LinkedIn, Instagram, and then recorded later on YouTube to watch again and again to your heart's content. Happy holidays all.